Hi everyone, and welcome back to my YouTube channel. Today I wanted to talk about how to purchase your first dividend stocks. I wanted to show you which tools I usually use to find good dividend stocks that are safe and a good investment in the long term. One of the best places to look when you're just starting your dividend investment is a Dividend Aristocrat list. Now, what's a Dividend Aristocrat list? The Dividend Aristocrats are a select group of 66 S&P 500 stocks with 25 plus years of consecutive dividend increases. Those are basically stocks that were able to pay and increase dividends for at least 25 years in a row. Obviously, just because company was able to pay dividends for 25 years in a row, it does not mean it will be able to pay it in the future. So you do need to do some homework and look into company finances, find out how it's doing right now, and make a judgment whether you think it will be paying dividends in the future. So I simply search for Dividend Aristocrat list, and I like this website right here, simplysafedividends.com. You can see the historical performance versus the rest of S&P 500. So as you can see, it did outperform it. I also like this graph right here. I think it's very important. You can see that most of the times Dividend Aristocrats did outperform S&P 500, but what's most important is that during the 2008 recession, dividend stocks actually lost a lot less value compared to the rest of the index, which is very important in my opinion. You can download the full list. And so what I would do is I would go through each company and I look at its financial information. So let's take a look at the 3M company with the ticker MMM. I like using a website called Seeking Alpha. Again, type it in Google and go to that site. In the search box, just enter the ticker name, which is MMM, and select the company. Now, let's go under the dividends. There's a lot of useful information here, so let's look at each one of them. The dividend yield, this is the yield you're getting if you're investing into this company. The payout ratio, this is a very important number. This is the percentage of the earnings that paid out. Obviously, the lower the number, the better. You don't want this to ever go over 100 because that means the company actually has to take on the debt to pay the dividends. And sometimes that does happen, but that shows that the dividend might be in trouble and the company may have to cut it in the future. Because don't forget, the company doesn't actually have to keep paying the dividend. They could cut it at any time. They might do it if they run into financial trouble. Right here you can see the 5-year growth rate. This is actually also very important because when it comes to dividend investment, you're not only looking for the company that pays out dividend every single year, but you also want the company to increase those dividends as well, because that helps with the compound interest. And that's really what it's all about. It's not about how much you save and invest. It's actually putting the money to work and make it work for you day and night. This is the compound interest calculator. I just wanted to show you how powerful compound interest is. Let's say we start with $10,000 initial investment. We'll add $1,000 every month. The interest is 10% a year. I know it might sound a lot or unrealistic, but actually that's average return for the stock market for the last 100 years. And the interest will be compounded monthly. Let's say we want to do it for 30 years. Click calculate. So here we can see that at the end of the 30 years, we're going to have $2,500,000. Out of that amount, over $2 million is actually compound interest. That's not the money that we saved and invested. That's simply money that worked for us. Now, let's go back and say we want to do it only for, 10 years. Click calculate again. we'll only end up with $230,000. And out of that, $100,000 is the earned interest. You can see the power of the compound interest. That's why it's very important to start investing as early as possible, even if it's only a little bit, because it's not about how much you invest, it's about how early. Let your money work for you. Now, let's go back to this information. You may often find stocks that pay 6, 7, 10, even 15% dividend yield. Be very careful whenever you see anything over 5%. Whenever the dividend yield is that high, there's a good chance that the stock simply dropped in price. And usually stocks drop in price when company having financial troubles, which means dividend cut most likely to follow. Let's take a look at company Macy's. If we look at its current dividend yield, it's amazing 23%. Now, I'm sure everyone wants to just jump and buy it, but let's look at it carefully. Let's go and look at the 1-year stock price. You can see the reason why the dividend is at 23%. Because a year ago, the stock was valued at $22.60, and now it's valued at $6. That's the reason why the dividend yield is so high. It's not because they kept raising it, it's simply because the stock price fell, and that caused the dividend yield go up. Be very careful and not chase a high dividend yield. Remember, purchase companies that not only pay dividend now, but will be paying dividend in the future. Now, just because the company did skip the dividend increase once in a while, does not mean it's not a safe company to invest in. For example, Canadian banks, known to be a very stable investment, and some been paying dividend for almost 200 years. Think about it. They were able to pay dividend through the First World War, Second World War. They were able to pay dividend even through the Spanish flu. Let's look up BMO in Seeking Alpha to find out more information about it. Current dividend yield is a very nice 5.87%. Payout ratio is 60%, which makes it very safe. And it does grow dividend. Not as much as some other companies, but they do grow it. Considering the dividend yield is high already, I think the low growth rate is tolerable. So what I would do is I would go through the list of the dividend aristocrats and choose maybe 10 companies in different industries and purchase their stocks. It's very important to have a diversification. I am a true believer that you should not invest more than 10% in one single company, no matter how solid you think it is. Whenever I talk about large companies, I like to mention the Dutch East India Company. Now, how many of you have heard about it? I'll bet not that many. Yet, this is the largest company in the history of the world. At its peak, it was worth over $8.3 trillion, accounted for the inflation. Just to give you an idea of what that means, if you take Google, Microsoft, Amazon, Apple, you're not going to come even close to that value. And yet today, nobody even heard about it. That shows you that any company can fail. I hope you find this information useful and it can help you with selecting your first few stocks. Again, if you have any questions, just write in comments and I'll try to answer it. Thank you.